In today's financial markets, fortunes can be made and lost in the blink of an eye, literally in microseconds. But what's the invisible moral compass that's supposed to be guiding it all? Well, today, we're going to dive right into what it actually means to trade ethically in this crazy age of data.
So let's just jump right in. This question right here, it gets to the very heart of modern finance. I mean, when you have algorithms making thousands of decisions every single second, the potential for things to go wrong and go wrong fast is just massive. So how do we build in stability and fairness from the ground up? All right, here's our game plan. We're going to start with why ethics are an absolute necessity in these high-speed markets. Then we'll break down the core principles and the actual laws that enforce them. After that, we'll stress test those ideas with some really tricky real-world dilemmas. And finally, we'll show you why being ethical isn't just the right thing to do, it's just playing smart business.
Okay, first up, why does all this speed need a compass? You know, in the incredibly high-stakes world of algorithmic trading, technology has basically supercharged both the opportunity and the risk. And that makes having a strong ethical framework not just a nice-to-have, but an absolute must-have.
You see, ethics here isn't about slowing things down. It's a crucial safeguard. Think of it like the brakes on a Formula One race car. The insane speed of data-driven trading can lead to things like flash crashes or create these totally unfair advantages. A strong ethical core is basically the braking system that protects everyone from the unintended and sometimes catastrophic consequences of that speed.
So, what does that braking system actually look like in practice? Well, let's get into the 4 pillars of market trust. These are really the core principles that form the moral bedrock for the entire financial system.
The first pillar is honesty and transparency. It sounds simple, but it is so powerful. Accurately represent opportunities. Be crystal clear about the risks and absolutely no deception. This is the foundation that all market trust is built on. Without it, the whole thing crumbles. Next up, we've got fairness. This is all about making sure there's a level playing field for everybody. It means you can't have manipulative practices like spoofing. You know, think of it like faking a punch in a boxing match to make your opponent flinch. You're placing these huge orders you never intend to fill just to trick the market and move the price. The goal here is to stop anyone from getting an unfair leg up through deception. Our third pillar is responsibility. And this is a big one. It's about recognizing that every single trader, every firm is part of this deeply interconnected ecosystem. Ethical trading means you have to think about the wider impact of your decisions. You have a duty not to destabilize the whole system, especially when you're using high-volume, automated strategies that can have a massive ripple effect. And our final pillar is stewardship. Now, for anyone managing money for other people, this is a truly profound obligation. It means you have to safeguard their assets and their data, you have to be free from conflicts of interest, and above all else, you always act in your client's best interest. It's a sacred trust, really.
Okay, so we have these fantastic principles: honesty, fairness, responsibility. But how do they go from being just good ideas to being hard and fast rules? Let's take a look at the legal blueprint that makes up the actual rules of the game.
This slide shows 2 of the most common types of illegal manipulation. So we've already talked about spoofing. Front-running is a little different. Imagine you're a cashier, and you hear that a huge lottery prize is about to be announced at your store, so you quickly buy up all the potentially winning tickets yourself. That's kind of like front-running. Using your advanced knowledge of a big client order to jump in and profit from the price move your own client is about to cause. Both are just classic examples of completely breaking market trust.
Now, these principles are enforced through a few key regulatory pillars. First, there's fiduciary duty. That's the legal obligation to put your clients first. Then you have strict laws against insider trading. You just can't use non-public info for profit. There are also broad laws that prohibit any kind of market manipulation. And finally, mandatory record keeping, which ensures there's an auditable trail for every single action. Accountability is key.
All right, now for the stress test. This is where those abstract principles and neat and tidy rules collide with the messy, high-speed reality of today's digital markets. Let's explore a few of these digital dilemmas, because this is where it gets really interesting.
First one. Your algorithm detects a coordinated pump-and-dump scheme that's brewing on social media. The signal is crystal clear, and there's definitely a quick profit to be made. But is it ethical to trade on it? You're stuck choosing between capitalizing on a market signal and avoiding participating in, and let's be honest, validating obvious market manipulation.
Okay, here's another one for you.
Your firm's technology gives you a millisecond speed advantage. It allows you to legally see and act on orders just before slower participants can. Now, it's not technically illegal front-running, but is it fair? This really gets into that blurry line between a legal competitive edge and a practice that just undermines the whole principle of an equitable market.
What about this scenario? You get legal access to a massive anonymized dataset. Let's say it's satellite imagery of retail store parking lots, and it lets you predict a company's quarterly earnings with incredible accuracy. Is it ethical to trade on that powerful insight before the official numbers are released to the public? Where's the line?
And finally, this one. Your cutting-edge trading algorithm goes completely haywire. It's spewing out erroneous orders and it's starting to distort the market. So what's your duty? Do you let it run to avoid a massive loss for your firm, or do you hit the kill switch to protect the entire market? The ethical choice is clear. You have to prioritize market stability over your own immediate profit.
So let's zoom out now and connect all the dots, because this isn't just about avoiding big fines or trying to stay out of trouble. When you look at the long game, good ethics is simply good business.
And the benefits are real, they're tangible. An ethical reputation builds deep, lasting trust with clients and regulators. It dramatically reduces your legal and financial risk, and you know what? It attracts and keeps the best talent because people want to work for companies that have integrity. All of this just fosters sustainable growth and improves everyone's confidence in the markets.
And this quote just captures the ultimate goal perfectly. See, ethics isn't about stifling innovation, it's about guiding it. By building new technologies and new strategies on a solid foundation of integrity, firms can create real, sustainable value that benefits everybody.
And that brings us to our final and maybe most crucial question. In this constant, relentless race for profit, a race that's fueled by ever-smarter technology, where do we draw the line between innovation and integrity? That's a question that's going to define the future of finance.